Welcome one and all to another installment of the Market Barometrix Macro Analysis series. In this video, we're going to be talking about inflation. Now, inflation just refers to an increase in the average prices of common goods and services. This is going to have several different implications. First of all, it's going to have an effect on the purchasing power of the local currency. It's also going to influence the spending patterns of individuals and businesses. It's going to change the relative attractiveness of certain assets. And it's going to be one more tool that we can use as traders and investors to gauge the overall health of the economy. So without further ado, let's dive in and learn a little bit more about inflation. Inflation is not just some intangible concept. It's a real, measurable, quantifiable number. And it basically takes a basket of goods and it tracks the average price of those goods through time. So inflation refers to the rate at which the average price of that basket of goods and services increases over time. When the average price of common goods and services is increasing, it effectively decreases the purchasing power of the local currency. So in the United States, when inflation is on the rise and the prices of common goods and services is increasing, the purchasing power of the US dollar decreases. So to paint an example, if you spent $1 on a product in January and there was 2% inflation throughout that year, come the end of December of that year, that same dollar might only buy 98 cents worth of the same product. Said another way, inflation essentially reduces the purchasing power of a currency. Conversely, deflation refers to a decline in the average price of goods and services. Now, this may be beneficial to the purchasing power of the US dollar, but generally it's detrimental to the profitability of businesses. So it's generally bad for the economy and the stock market. On the other hand, too much inflation can also be bad for the economy and the stock market. What you want to see is a healthy growth rate in inflation of about 2% per year. And that's usually the target of the Federal Reserve. So outside of the effects of inflation on the economy and the stock market, inflation or deflation has wider implications to holders of hard assets. For example, if you own property or own stored commodities, a healthy growth rate in inflation is going to increase the value of those assets. On the other hand, if you have a large cash position, increases in inflation are going to erode the purchasing power of that cash, which wouldn't be desirable. So the reason that target inflation is usually around 2% is because that strikes a healthy balance between a couple of underlying factors. First of all, when there's a little bit of inflation, it's going to incentivize individuals and businesses to spend money, because saving money and saving cash when inflation is on the rise is going to erode the purchasing power of that cash. So saving cash over time when there's inflation is not desirable. On the other hand, when there's too much inflation and prices become too expensive, it's going to dampen demand for those products and in turn slow down economic activity. There are several root causes of inflation, the first of which being demand pull inflation. Now, this happens when there's not enough supply of a product or service to meet demand. So in this case, there's more competition to purchase that product or service, so demand pulls prices higher. A basic example of this would be if an oil-producing country decided to cut back on their production of oil. This would create a reduction in the supply, but there's going to be the same amount of demand for oil. So now there's going to be greater competition for the reduced supply of oil. Demand is going to pull those prices higher. Another root cause of inflation is known as the cost push effect. Now, this happens when the price to produce a good or service increases. This can happen for several reasons. An example would be the price of the raw materials to produce a good or service increases, or maybe the labor involved increases. The last root cause of inflation is known as built-in inflation. Now, this has to do with a back and forth between rising prices for goods and services and rising costs of labor to produce those goods and services. So when prices rise, laborers require greater wages to maintain their cost of living. As cost of labor rises, prices in turn rise. This goes back and forth, causing built-in inflation. So popping into the market barometer here, we have several different measures of inflation. Now, each of these is going to measure inflation in a different way. So for example, the Consumer Price Index, or CPI, that's probably the most popular, most quoted measure of inflation. It measures a fixed basket of goods and services. Next door to that, the CPI, not including food and energy. This just takes the same measure, the same basket of goods and services, but it subtracts the prices of food and energy. Food and energy prices tend to be a little more volatile, so subtracting them can be advantageous and lead to less fluctuations in this metric. The core inflation rate is one of my favorite measures of inflation because this essentially takes the CPI, not including food and energy, and puts it in a year-over-year percent change basis. Makes it really quick and easy to see what the growth rate is doing in inflation. So this is interesting to look at, around the time of the Great Recession, 2007, 8, 9 here. You can see inflation ran hot, up as high as, 5.5% or so. Before turning the other way, we actually entered a deflationary environment here in 2009. So these are good things to keep track of to kind of understand what's happening with inflation and the likely effect that's going to have on the economy and the stock market. Moving over to the GDP Implicit Price Deflator, yet another look at inflation. And this does not measure a fixed basket of goods and services. It's a rotating basket of goods and services aimed at providing a more comprehensive measure of inflation. In the bottom left here, we have the personal consumption expenditures, yet another measure of inflation. This is actually the primary index used by the Federal Reserve to measure inflation. So tracking and monitoring PCE can give you a good idea of the Fed's take on inflation. Lastly, in the bottom right, we have the Producer's Price Index. This metric looks at inflation from the perspective of the industries that produce these products and services. When you put all these things together, we get a comprehensive look at the different measures of inflation, and we can really understand the theme and trend in inflation, allowing us to gauge the effect of inflation on the economy, the stock market, and the purchasing power of the US dollar. So to recap, inflation just refers to increases in the average prices of common goods and services. It can be either a good or a bad thing depending on your perspective and depending on what degree to which inflation is growing. The Federal Reserve's general target for inflation is about 2%, and that's because that level tends to strike a good balance between incentivizing individuals and companies to spend while not increasing the price of common goods and services too quickly and dampening demand. The Market Barometer offers us several different measures of inflation, each of which is going to give us a unique perspective as to the growth rate in inflation. And it's going to clue us into the likely effect that it's going to have on the economy and on the stock market. As always, if you guys like this video, subscribe to our channel, hit that like button, leave any comments down below. And until next time, thanks for tuning in. We'll see you guys in the next video.